Hello, and thank you for tuning in to our second quarterly market update here with the Curo Investment Committee. I am Atricia Roberts, COO and partner, and I am joined by our CEO and partner, Anne McCabe, Investment and Planning Associate, Zander Cochran, Drew Culver, Financial Advisor, and the newest member to our Curo family, Manny Carranza, also an advisor. So we will start this update with just a quick reminder of how 2023 ended. And we ended with a strong labor market with job openings still plentiful and unemployment below historic averages. The consumer remained resilient, continuing to go out and spend. We got higher than expected GDP growth, pushing out the expectation for potential recession even further. We saw increasing expectation for the Fed actually pulling off their soft landing, which also saw the Fed pause interest rate hikes last year. And then, of course, in a reversal of 2022, we got positive stock and bond performance last year. So 2024 has been off to a pretty good start. We have seen inflation be hotter than expected, seeing an increase of about 0.4% in March, keeping that core inflation number above 3%. We also have seen the market start to price in fewer rate cuts. At the end of last year, we were expecting as many as 6. That number has been reduced to closer to 2 cuts and later in the year. Interest rates have headed higher, but stocks are off to a great start. And we've even seen stock performance starting to broaden, with not all of the performance focused in those top 7 companies that we saw last year. And then manufacturing found a bottom in 2023 and is now headed back to a positive direction. So overall, off to a great start in 2024. So now I'll hand it over to Zander, who will go in through some of the economic dashboard.
All right, thank you. So this slide here starts off looking at different aspects of the economy and how it's doing from a positive to negative perspective. And so first we see the monetary policy, which is in the gray or neutral territory, because we've seen hotter than expected inflation going into this year. This is tempered what the Federal Reserve has been doing with interest rates and continuing to have a higher or a longer pause than expected for interest rates. Next, we see manufacturing, which this had been in the red territory and moved into the gray territory. As we've seen in March, a first time the manufacturing index hit positive territory after nearly a year and a half of being in the negative territory. So this is definitely a positive part of the economy. Next, we see the consumer, which overall has been fairly strong as people have had income coming in and then going and spending their income. However, we have seen this come down slightly as the consumer is starting to struggle a little bit more as we've seen an increase in delinquency rates. And also consumer confidence remains below average. Next, we have the housing sector, which has struggled a bit for a while as there's a limited amount of housing supply, as well as higher mortgage rates makes it harder for people looking to buy houses now. And then lastly, we have the labor market, which has continued to be strong as there's plentiful amount of jobs and job openings, while they've come down a bit, are still higher than the amount of people who don't have jobs, and unemployment has remained near historically low records. So this slide here zooms in on CPI inflation. And so you can see here, inflation over the past several months has been bumpy. We saw initially inflation come down from over 9% to 3% as of June of 2023. However, over the past 9 months, inflation really hasn't made much headway and currently is at 3.5%, which is above the Fed's target of 2%. And it's definitely taking longer than expected to get inflation down to the target. Next, we see here delinquency rates have continued to rise. And so particularly credit card debt has as credit card balances have increased and interest rates as well. It's making it a little bit harder for consumers to pay off those credit cards. And other loans as well have hit around pre-pandemic levels, whereas credit cards are above pre-pandemic levels when it comes to delinquency rates. However, the positive is it's not nearly to the level where it was during the great financial crisis in 2009. And lastly, we have a slide here on consumer sentiment. And so while the economic data that's been coming out over the past year has been positive, and it's definitely good to see growth, not all consumers feel that way about the economy, especially as consumers have struggled with higher inflation and prices over the past few years. We have seen an uptick in consumer sentiment over the past several months. However, it's still below average compared to where it historically has been. With that, next I'll turn it over to Manny to review our market.
So taking a look at the market year to date, it's had its strongest start to the year since 2019. Stocks are up about 10%, bonds are down about 1%, and real estate is also down about 1%. The growth in stocks has been led by a resilient economy, expectations that the Fed will cut interest rates later this year, and excitement around AI. In the next slide here, we're going to be taking a closer look at stocks and the Magnificent Seven. So the Magnificent Seven, what they represent is companies like NVIDIA, Meta, and Amazon, and their performance is reflected by the blue line here. And then other indexes, specifically the rest of the S&P 500 is represented by the gray line here. As you can see, the Magnificent Seven on their own have significantly outperformed the rest of the S&P 500. And this raises some concerns because as they continue to grow, so does the S&P 500's reliance on the tech sector for growth, and that could impact diversification. Another topic that's been top of mind for clients recently has been whether it's a good time to invest their sideline money, especially with the S&P 500 hitting new highs. So what this graph here represents is the cumulative total returns of the S&P 500 since January of 1988 to December 31st of 2023. The gray bars here represent investing on any given day. And then the green bars here reflect investing at a new high. So if we take a look here, since 1988, the average 12-month return on the S&P 500, 1 year after an all-time high, is about 13.7%, versus taking a look at investing on any given day, your return would have been about 11.9% on average. So next, I have my colleague Drew Culver.
Thanks, Manny. So yeah, another recurring topic that we're seeing pretty often this year certainly is the election. So looking below is the average return for non-election years versus election years. So the dotted red chart shows non-election years, and that dark blue line below shows average returns throughout election years. So while there is certainly a lot more volatility in those election years, they're very similar returns overall and even slightly higher. Another important thing to note is that we've had a lot of people say that they'll wait it out, they'll wait till the election's completed, and then they'll throw their money into the market. But if that's the case, you'll certainly miss those summer months where the majority of the returns have actually come through election years. Of course, past is not indicative of future returns, but if we're basing anything off history, it could provide great opportunity. And then certainly at the far left side of the chart is what we've done year to date. Through the end of March, we were up nearly 10%. As of April 22nd, we're sitting around 5 to 6%. So we still think there's good runway there. The strong returns have certainly been based off good earnings from companies. And we have two former presidents, one sitting president running for election, which isn't always normal. So we have a slightly better idea of how their policies may be next year. So taking into account all the market activity that we just discussed, some of the portfolio themes that we're taking and and using are to increase value stocks versus growth stocks, because as Manny said, tech has really had a runway, but it's dialing back slightly. Another thing that we're doing is increasing equity slightly over bonds. And another is we're increasing duration. So we're taking you and putting you in slightly longer bonds just to really lock in those higher rates for longer. And lastly, we're just diversifying across emerging markets a little bit more, so a little more access to the countries out there that we believe will provide you better opportunities. And on that note, I'll hand it over to Anne.
Thank you, Drew. So I'm going to finish us out today by reminding us all that as long-term investors, it's very important to zoom out and consider long-term performance of the stock market as well as other asset classes. So you may have seen this chart before. We've shared it a lot. It's one of our favorites. What we're looking at in this chart is data going all the way back to 1802. So definitely long-term. And what it shows us is if we were to have invested $1 in the stock market, that dollar would have grown to over $2.1 million. Versus if we had put it in bonds and a few other asset classes that you see there. So it is a huge difference in performance in the stock market when you compare it to these different asset classes. So one of the things we can take away from this chart is that hands down, the best place for us to grow wealth over the long run has been, and we believe will continue to be, in the stock market. If you see gold there, we've been getting some questions around gold. It's definitely been in the news a lot recently. It has performed fairly well so far in 2024. But what we've seen historically is, number one, not a great place to grow wealth over time. And number two, we tend to see outperformance in gold in fits and starts, but it's not been historically a great place to grow wealth. So stocks really are the place to be over the long run. And the last visual we wanted to share with you is a reminder around where we try to live as your Curo team when we work with you all day in and day out on your financial planning and your investment management. So as you can see here, we have two concentric circles, and where we really try to focus our time and attention is where what matters in your lives and what we can control come together. And as a reminder, the three things that we believe are 100% in our sphere of control and make a big difference to us achieving our financial goals is, number one, having and working a financial plan, which we're here to help you with. Number two, the mix of stocks and bonds in your portfolio, or asset allocation is another way to say that. And then number three, and arguably most important and sometimes hardest, is maintaining our emotional centeredness when the world is going crazy around us, when the markets are volatile, or there are geopolitical events, or some other scary piece of news that we hear or that we read, not making short-term impulsive decisions that will be detrimental to our long-term financial positions. And then as a reminder, what we can't control as much as we would love to is being able to time the market, the ups and downs of the market or volatility, and lastly, what the heck Congress decides to do from a policy and a tax law change standpoint. Can't control it. We have to deal with it when it comes down the pike. So that concludes our presentation on the activity in the first quarter of 2024. Thank you so much for taking the time to watch this. We hope it was informative, educational. If you have any questions or would like to discuss anything that you heard here today, please feel free to reach out to anyone on the team. We would be happy to have a conversation with you. Thanks as always for the trust you place in our team, and we look forward to seeing you soon. Until next quarter, take care.